You know the old saying, don't put all your eggs in one basket. Someone took it really seriously. And now we have index funds, mutual funds, and ETFs, all designed to spread your money so thin you might not even notice where it's going. While they all seem the same on the surface, there are actually key differences that could make or break your returns. In this video, I'm going to help you break it down so you could pick your best bets and avoid accidentally diversifying yourself into mediocrity. We're beginning with mutual funds, and I'm starting with them first because they've been in existence for a long time. In fact, the first ever mutual fund dates back to 1774. That's older than your grandpa's grandpa. In simple terms, a mutual fund pulls funds from individual investors and allows them to invest in a portfolio of stocks and bonds together. Instead of buying stocks individually, a mutual fund buys many stocks for everyone at one go. Mutual funds offer a direct path to diversification, a technique that involves spreading your investments over a variety of assets in an attempt to mitigate risk. By combining assets of many investors, mutual funds can pool investments in a variety of securities, including stocks, bonds, and other assets. By taking a group approach, individual investors can gain access to diversification with ease, without needing to buy individual securities independently. Because, after all, humans are lazy. Diversification is one of those investing buzzwords that basically means don't put all your money in one bad decision. Think of it like running a marathon with just one pair of socks. If they fall apart, so do you. By spreading investments across different assets that react differently to market chaos, you're not guaranteed to win, but at least you won't wipe out completely. Instead of spending hours researching stocks and needing a fortune to build a decent portfolio, investors can just buy a piece of a mutual fund and let someone else do the work. It's less effort, requires no real expertise, and gives access to investments most people couldn't afford on their own. Basically, it's a way to feel like a smart investor without actually being one. For example, Vanguard 500 Index Fund lets you own a tiny piece of 500 big companies, so you can casually mention at family dinners that you own Apple. Fidelity Contra Fund? A fund manager takes your money and bets on stocks they think are undervalued, because guessing is a strategy, apparently. T. Rowe Price Blue Chip Growth Fund? Just a collection of companies that were already doing fine without you. There are thousands of mutual funds out there, because Wall Street loves giving you more choices than McDonald's. So, you may be wondering, who does the job of actually buying and selling the shares in all of these companies? Mutual funds come with something called expense ratios, which is a fancy way of saying fees that eat into your returns. These cover things like management salaries, admin costs, and whatever else they decide to charge you for. Even small differences add up. A 0.5% expense ratio means you pay $50 a year for every $10,000 invested, while a 1.5% expense ratio means you're handing over $150 for the privilege of letting someone else manage your money. These management experts are called fund managers. Even if they fail to give you a return, a fund manager will still receive a big salary regardless. Meanwhile, a portion of your investment gets skimmed off every single year. It doesn't seem like much at first, but over time it adds up, because that money could have stayed in your pocket. So, what's the real problem with mutual funds? Fees. Fees and even more fees. It's basically like paying for a streaming service where the only content is ads. Now, let's speak about index funds. Index funds were developed to remedy the ills of mutual funds. Instead of a fund manager acting as your foreman in the stock market, buying and then selling at will, an index fund simply duplicates a collection of stocks, otherwise known as an index. There's no additional trading, no games of chance, just a simple mechanism for tracking an index, such as an S&P 500. Jack Bogle was the founder of index funds. He noticed many costly mutual funds underperformed anyway and simply said, "We can do better." Index funds revolutionized investing by cutting out costly fund managers and significantly reducing expenses for investors like you. Some index funds' expense ratios are a mere 0.04%, compared to the regular mutual funds, which range between 1 and 2%. That is equivalent to purchasing the same concert ticket for $10 instead of $500. That's insane, So we decided to dedicate this poem to Jack Bogle. Jack Bogle came through, made fees topple, had Wall Street suits in a full-on struggle. They tried to fight back, but they started to wobble, while index funds rose up to gobble the market double. Hail Jack Bogle. But I digress. For instance, the Fidelity 500 Index Fund and Schwab S&P 500 Index Fund tracks the S&P 500 index and boasts a very low expense ratio. Therefore, both are ultra popular for investors who desire to have many stocks in their portfolio. Another positive thing about index fund is fewer buying and selling transactions. Because an index fund simply duplicates an index. It doesn't move them about a lot, producing fewer taxable events. We call them passive management, compared to regular mutual funds, which are actively managed. Now at this stage, you're probably thinking, why in the world would a person ever want to make an investment in a mutual fund, especially with higher fees? That's a fair question. Some believe the fund managers from actively managed mutual funds could beat the market for them consistently. Although history tells us that in the long run, most actively managed funds underperform in relation to index funds. In fact, in 2007, Warren Buffett made a 10-year bet with a hedge fund called Protege Partners. Buffett picked the passively managed Vanguard 500 index fund. Protege Partners picked a basket of 5 actively managed hedge funds. After a 10-year battle, Buffett's index fund returned 125.8% plus. The hedge funds, a pathetic 36.3% plus. Well, but the fund managers at Protege Partners did make more money from you, just not for you. And now, when you're convinced you have a grasp, then ETFs, exchange-traded funds, come and make it even more complex. ETFs function in a similar manner, typically tracking an index and with low expense ratio, but with a key variation. You can purchase and sell them similar to stocks, unlike mutual and index funds that are bought or sold at the closing price at the end of the trading day. ETFs can be bought and sold anytime during market hours because, apparently, patience is overrated. The problem? Investors love panic selling instead of holding long term. And let's be honest, most people are terrible at predicting the market. You see your ETF drop midday, freak out, sell it, and by Friday, it's back up. Congratulations, you just locked in an unnecessary loss. Truly, a masterclass in overthinking. Here's a fun fact no one asked for. ETFs don't automatically reinvest dividends. Unlike index funds, which politely handle it for you like a responsible adult, ETFs make you do it for yourself. It's not hard, but it does require clicking buttons, an outrageous level of effort in today's world. Another thing to consider, minimum investment amounts. Mutual funds usually demand a few $100 to $1,000 up front, because apparently they need to test your commitment. ETFs, on the other hand, let you buy just one share, making them ideal for people who enjoy investing, but not too much. It's the difference between buying a whole pizza or just taking a bite and calling it a meal. ETFs are generally smarter for taxes compared to mutual funds. Thanks to their structure, they come with fewer capital gain distributions, which means less money lost to taxes. That's the good news. The bad news? Taxes are unpredictable, constantly changing, and designed to make your head hurt. So unless you enjoy deciphering tax codes for fun, it's probably a good idea to talk to a tax advisor. Remember, the 3 certainties in life: death, taxes, and the market randomly tanking when you least expect it. So, which one is best for me? Well, that depends. What kind of investor are you? If you like things simple, cheap, and stress-free, index funds are your best bet. You invest, forget about it, and avoid the existential crisis of making constant decisions. If you prefer someone else handling your money, don't mind paying extra fees, and truly believe your fund manager has superpowers that will beat the market, then a mutual fund might be for you. Just remember, you're paying for that privilege, whether it works or not. And in case you desire a fund such as an index fund, but enjoy the flexibility in buying and selling a lot during trading times, then ETFs could work for you. Just don't overdo it. Now, after learning about the differences, which do you prefer? Mutual funds, index funds, or ETFs? Before you comment below, click the subscribe button because I don't charge you an expense ratio.